We got two numbers that came out this week: CPI and PCE. And I think maybe it's important that we just level set on the difference between these two, what they are,
Mhm.
how they're measured, for the audience before we jump in. So, CPI is an abbreviation, it stands for Consumer Price Index, and it's a measure of inflation produced by the Bureau of Labor Statistics, the BLS. It tends to show higher inflation, although it's not right now.
Mhm.
It tends to show higher inflation because it measures out of pocket spending by urban consumers
Okay.
only. So it just captures one section or cross section of the consumer. As it relates to housing, CPI has a higher weight to housing than PCE, making it a little bit more sensitive to rent price fluctuation. And that might be why it's lower right now. If
Yep.
having a higher weight, rents have been, on the downturn, as everyone has seen.
Yep.
So um, their weights are updated annually, so it's not as fresh and dynamic as PCE.
Yeah.
So PCE is an abbreviation for personal consumption expenditures, and it's also a measure of inflation, but it's produced by the Bureau of Economic Analysis,
Mhm.
which sounds like they have great holiday parties.
Yeah.
I mean, you have to agree, right? PCE has a broader scope than CPI and includes rural households as well, and weights are updated monthly here. So I bet you can guess which one the Fed prefers.
Yeah. I have some thoughts I will share that I like, but yeah, I know it.
Yeah, yeah. The Fed likes PCE and prefers specifically core PCE, which strips out volatile commodities like food and guess what, oil prices. Yeah. Um, I just briefly want to touch on kind of the full employment portion of the Fed's dual mandate for a minute and point out what's happening abroad because I think it is instructive to what we're seeing today, right
Yeah.
now in the Treasury market. So the ECB cut rates a bit more aggressively than we did. That is the European Central Bank
Okay.
cut rates a little bit more aggressively than we did. And we've been kind of hanging out in what I think of as kind of still restrictive territory. So
Yeah.
room to move down by the Fed. But they've been a little nervous to do that. The European Central Bank moved a little further down than we did. And that's prompted this thought that, this inflation, this oil issue, the market says, hey, ECB may have to actually raise rates 25 basis points at their next meeting,
Okay.
which is throwing, the treasury market into a frenzy right now.
Okay.
Another thing to point out from an article I read this morning from the Indy Star, and Jordan Smith noting that Indiana topped the list of markets for home foreclosures in February. That's not real great company to be in. The article notes comments from Sarah Kors, the associate director of Indiana University for Real Estate Studies. She and others attribute this recent spike to um, rising escrow amounts, specifically increased property
Okay.
taxes and insurance.
Yeah.
So what we're seeing here, we've felt it acutely in the commercial real estate space.
Mhm.
The rise of insurance, the rise of property taxes, homeowners are feeling it now.
Yeah.
Okay, so what does that mean? Well, that means this is a bit of a bellwether for the economy overall,
Mm.
and something that we want to pay very close attention to. So I can see a scenario as it relates to interest rates,
Yeah.
right? Kind of bringing it back to that. I can see a scenario where economic conditions, including unemployment, deteriorates
Mhm.
in the near term, which will put more pressure on the Fed to choose fighting inflation or fighting unemployment rather than fighting them both at the same time.
Yeah.
And it's going to be interesting to see what wins out, whether job loss is more important than some random 2% inflation target. So we'll see how that shakes out.
Yeah, there's still, I think, a really good chance that we would see interest rate cuts just because of just because of like employment getting hammered and the stress in the economy in general. I think that yes, oil prices have made incoming Fed Chair Kevin Warsh's job uh, very difficult, but the recent numbers from the PCE and CPI give us a useful perspective on the inflation landscape in the days leading up to the conflict with Iran. So we don't have the post Iran conflict numbers yet, but we know what things looked like before the conflict, and they weren't particularly bad. It wasn't like there was runaway inflation. So that could hopefully kind of support the idea that, all right, underneath this temporary stuff, and that's why they follow core and not oil. Maybe underneath this temporary stuff is an economy that would really benefit from interest rate cuts. There does seem to be, I will admit, a broad consensus that the PCE index is better at measuring inflation than the CPI. And the CPI, I guess, maybe more popular because it's a little older. There's a little bit kind of an incumbency effect where they're using it. Businesses are already using it because other businesses have been using it. So there's that. It's the CPI numbers come a month earlier than the PCE numbers as well. So there's some usefulness in that way, but um, I'll also add that it's easier for me, at least, to use, view, and access the data from the CPI compared to the PCE. But that's open. That's a little more open to argument. Let's get into headline numbers. We'll start with PCE because you love it so much, Dan.
I do.
Headline year-over-year inflation, it was 2.8% in PCE year-over-year, down from 2.9% in December. Core year-over-year inflation, which excludes food and energy, is 3.1%, which is up from 3%. Essentially, we're looking at a flat movement, basically. CPI headline inflation was 2.4%, same as previous month, and core 2.4, same as previous month. So CPI, PCE, again, relatively the same. But a recent PPI, which is the producer's price index, was hotter than usual, jumping from 2.9% year over year to 3.4%. That's a big jump for 1 month. And so the monthly increase was 0.7%, but that threw the year over year to up 50 basis points. So it looks like we're headed to a higher inflation environment, and that's even excluding the oil prices. However, I do think that those single month jumps, I don't know if that's corrected or not, but I'd like to dig into why the numbers from the PPI jumped that big. But
Yeah, and it's important, I think, to point out too, Matt, that PPI is a leading indicator,
okay.
right? So PPI is producer price index. So it's what producers or operators are paying for product before it reaches a consumer.
But the war wasn't on when the PPI stuff got
True.
started. Was
So
this anticipation of a war, or because I know there was a little bit of there was a couple weeks of like talks with Iran, and maybe that I just don't see that sparking a 0.7% increase in
I
PPI.
wouldn't think so either. I think possibly it's finally the lagging impact of tariffs.
Yeah, man. I was hoping that they wouldn't show up. At
Me
first,
too.
I was like, "They're gonna show up," because I just don't like the idea of curse, doesn't make sense to me, and so I was like, well, begrudgingly, thinking that it would, and now that they haven't shown up, I don't want them to show up ever
Yeah.
anymore. So, but yeah, alright, I do wanna get it other than tariffs, I wanna get into housing and shelter. There's a whole bunch of different price categories that we can follow that are really fun. I like following egg prices. Did you know that they're down 41.2% since that last year?
Fantastic.
Looks like we don't have inflation at all. If you're the Easter bunny. But since we focus on the apartment market, I want to spend that time on home prices, shelter, rent prices in the CPI. And I'll do a little explainer here because it's fun. The CPI measurement for home price inflation is called owner's equivalent of rent. They gather this information. It's just a weird way of doing it because they want to measure home prices as a service instead of like as an investment. So they go around and they ask homeowners, hey, if you were to rent this house, how much would you rent it? And that's the price they use to determine what percentage home prices are up or down. Again, it's a little bit inexpert, but that's all we've got. I'll stick with Case Shiller personally, but that's just me. The CPI measurement then for rent growth is called rent of primary residence. That's a more direct measure of rent growth, but it too I think has its flaws. They measure different cohorts of renters, and and they ask them every 6 months, and they kind of swap out every month. They're swapping out a different one, and because they're measuring them every 6 months, and also because they're measuring in place rents instead of asking rent, which is what the new rents go for, because they're measuring that there is a little bit of a lag, right? You're not getting the current the prices that are being negotiated on the market, you're getting the current prices people are paying,
Mm.
which is useful for some people, but maybe not necessarily a good leading indicator. And it is very clearly lagging behind the current data that we get from places like Yardi Matrix, CoStar, Apartment List, etc. And I made a nice, useful graph here because I think that it's instructive to see how this lag has changed. I did look up the where the lag in CPI rent growth was between apartment lists using that specifically, and it started out the initial low point was in 2020 for apartment lists about July. The low point in the CPI was April 2021. That's 9 months of a lag. But then the next lag between the two peaks, that was 15 months. So it peaked in apartment list, and then 15 months later, it peaks in the CPI. Now, the lags are getting bigger. That's a 6 months jump. And the lag now for the most recent rent growth low point as measured by apartment list is 29 months and counting. Apartment list hit the low in September 2023, and CPI still is not there yet. There is a lagging effect that's becoming less predictable, I think. It's becoming just completely disconnected.
Hmm.
So I think that it's not even useful almost to talk about it as a lagging effect or a leading indicator. It's just kind of unmoored and not as useful of a tool. So that's what I wanted to say there. Ultimately, if you do look at shelter prices in general, they are coming down, and that's, I think, the story that is worth telling. We can quibble about how they measure it or whether or not things are a leading indicator or things are useful, but I think ultimately the story of shelter prices going down is what the Fed would listen to, and is what kind of it's an accurate reflection of the economy, I think. It is still, for as much as things are disjointed and disconnected, it's true that prices are softening in shelter prices in the CPI, the PCE, in the private markets, whether you're looking Case-Shiller or apartment list or, the government numbers.
Mhm.
They all seem to be softening and going down, and that's good news, I think, for just like inflation readings, and hopefully we will, maybe see a rate cut.